Welcome to lecture 6 of business taxation, and we are going to discuss some different rules regarding calculating the taxable income on different facilities provided by the employer. Moving towards the contents, so first we would look into the medical facility or medical allowance, right? Again, following the similar pattern that we use in our previous lecture. We would first look into the allowance category, and then how do we calculate the taxable income if there is a facility provided by the employer. As we saw in case of house rent or housing facility, there was either a house rent allowance or a housing facility. Similarly, with the case of conveyance, either there was conveyance allowance or conveyance facility. So similar is the case with medical facility. Then we have entertainment. We would look into how to calculate taxable income, whether it is taxable or not. Then there is loan provided to employees by the employer. And then there is the case of Provident Fund, which we would discuss. So starting with medical facility. So there are two ways that employer facilitates the employee. Either they would provide a medical allowance. So whatever expenses that the employee would occur, uh, either they would buy medicines or they are hospitalized, they would have to incur from that specific amount that is there, whether they use it or not. So the monetary benefit is provided by the employer. The second is normally some kind of insurance, health insurance, or medical facilities provided. For example, the employer or the company might say that uh, the employee can incur medical expenses or be hospitalized and incur medical expenses, and once they incur, they would bring us the vouchers or receipts, and we would reimburse them the amount, right? So in this case, the medical facility is provided, right? In same is the case with insurance. In case of insurance, the employer would pay, let's say, 1,000 or 10,000 or 5,000 rupees per month on behalf of employee, and the employee would get a health insurance. So if in case the employee is hospitalized, then this insurance company would incur all the expenses of on behalf of employee. So whatever the case is, so in case of this facility, so if the employer receives free medical treatment or is hospitalized, or the amount which the employee incurred or medical expenditures or expenses is reimbursed, then this medical expense are not taxable. So the idea is simple. If the medical facility is provided, then in that case all the medical expenses are not taxable. If medical allowance is provided, that is monetary benefit is provided, then in that case it is exempted up to 10% of the basic pay. Whatever the basic pay is, if the medical allowance is less than the 10% of basic pay, then that is not taxable. If the medical allowance is greater than, so medical allowance is greater than 10% of basic pay, then it would be taxable. The excess amount would be taxable, just the excess amount, right? Okay, so let's have an example. Mr. A's annual salary is 5,40,000. His employer also provided him medical allowance of 5,000 per month. Actual medical expenditure for the year 2019 that Mr. A incurred was 42,218. So remember, this is the actual medical expense that Mr. A incurred and was reimbursed by the company. It is totally not taxable. We do not pay tax on this amount, so we would not worry about this amount. We would not get this amount into our calculations. We would just have to worry about this one. So we would first have basic salary, that is 55,40,000. Then we have medical allowance, which is 5,000 into 12, that is 60,000. How much amount is exempted? 10% of basic salary. So 10% of basic salary, 10% of salary in this case, the basic salary in this case, this would be 10% of 5,40,000 would be 54,000. So we are getting 60,000 as medical allowance, 54,000 exempted. So the remaining 6,000 will be included in our taxable income, right? What if instead of 4,000 we were only paid 4,000 rupees? Then this amount, our medical allowance for the year, would have been 48,000. Now this 48,000 is less than the tax 10% of basic salary. Remember, we said if medical allowance is greater than 10% of basic, then the excess amount is taxable. What if medical allowance is less than 10% of basic? Then not taxable. So in this case, medical allowance, which is 48,000, is less than 10% of the basic, so it would be not taxable. So our total amount, taxable amount, would be for 5,40,000 if our medical allowance is 4,000 per month. Let's move to our second topic, which is entertainment allowance. So in entertainment, if expenses incurred on behalf of employer, so let's just say employee incurred some expenses on the behalf of employer and then that expenses was reimbursed by the employer, then that all amount is not taxable. Tax will not be calculated on that. If some free or subsidized tea, coffee or lunch is provided during work hour, again that is not taxable. Any other amount which is provided either on the entertainment allowance is taxable, right? So we move to the third aspect, which is loan. So in loan, if the loan amount, so normally what the employers do is that they provide the loan facility to the employee. Employee can get loan from the employer, either it is interest-free loan or there is some nominal interest on it. So whether it would be taxable or not. So in that case, we have this rule: if loan amount is less than 1 million, that is 10 lakh, then the whole amount is not taxable. The loan is not taxable, the interest is not taxable, or whatever the amount is, it isn't taxable. The simple idea is that if loan amount is less than 1 million. What if the loan amount is greater than 1 million? Then we would again have two cases. One case is if there is an interest-free loan. If the loan is interest-free, then 10% of the loan amount will be taxable. So if loan amount was just say 12 lakh, that is 1.2 million, right? This was the loan amount that employer provided to the employee. Now it is greater than 1 million, so we would have to check this category. If it is an interest-free loan, right, then 10% of this amount, which would be 1,20,000, this would be taxable, right? What if there is some interest? I mean, the employer didn't provide the loan interest free, but rather there is some interest, but the interest is less than 10%. Let's just say it is 7%. There is 7% interest. Then the difference between the interest amount and the 10% of is taxable. So in this case, if 7% is the interest that is being charged by the employer, so the difference between 10% and 7% is obviously 3%. So this 3% of this loan amount would be taxable. Okay, so let's move towards the example. Mr. A is receiving a monthly salary of 80,000 rupees. He received an interest-free loan from his employer in 2019 amounting to rupees 17 lakh, right? Calculate the taxable income for year 2019. So now it is greater than 1 million, right? So which rule would we follow? We would follow this specific rule, right? Next, we would see if it is interest free or there is some interest on it. He received an interest free loan, so we are concerned with this rule, right? So now 10% of the loan amount is taxable. It is simple as that. So let's calculate the taxable income. So we have the basic salary, which is 80,000 rupees per month. So we would have 9,60,000 rupees. Then we would calculate loan amount. So the loan is 1,70,000 and we would calculate 10% of 1,70,000, and this 10% of 1,70,000 would be, and the total amount would be 1130. So this would be our taxable income, right? What if it wasn't interest-free loan, rather the employer charged an interest of say 8% on this loan? Then the difference between 8% and 10% is 2%. In that case, instead of 10%, we would only charge 2% of 1,70,000, and similarly this amount would also be changed. So let's move to the next topic of this lecture, which is Provident Fund. So we have different types of Provident Fund. First, we have Government Provident Fund, which is provided by governmental institutions or semi-government institutions. So public sector universities would provide Governmental Provident Fund. Similarly, WAPDA or Railway or any provincial government institute would always also provide this Government Provident Fund. First, what is Provident Fund? Provident Fund is a facility that is provided by employer. What we do is normally is that each month certain amount is deducted from the employee's salary. For example, 5,000 rupees is deducted each month from the employee's salary. This would be called employee's contribution to Provident Fund. Similarly, some amount, let's just say 5,000, would also be provided by employer. So this would be called employer contribution to Provident Fund. Then, so monthly there is a 10,000 rupees that is being saved. This amount is then invested, and when this employee would retire, this whole amount, this employee's contribution, the employer contribution, and the interest calculated on this amount would be provided to this employee. So we have government provident fund, then we have recognized provident fund. These recognized provident funds are the funds that are recognized by the FBR. Then we have unrecognized fund. These are not recognized, either they have not submitted the application for being recognized, or for some lack of not fulfilling the criteria, they are not recognized. So we have these three different types of provident fund, and the treatment of taxable or the tax is different for these three funds. Then we have, again, in previous slide we just discussed what is employee contribution. This is the amount provided by the employee, right? Amount deducted from employee's salary. Then employer contribution, it is the amount provided by the employer. By employer. The interest amount is that these two amounts are added up and deposited in a bank in some saving account, and interest is earned on this amount. This is the interest on provident fund. And at the time of retirement, this combination of all these, the employees contribution plus the employer contribution plus the interest amount, is added up, and then it is given to the employee. This is called a receipt of accumulated balance. Okay, let's look at the treatments. What would happen? So we have four things, and the treatment is different for all these four, and further this treatment is different within this employees contribution. It would depend whether it is a governmental provident fund, recognized provident fund, or unrecognized provident fund. So in case of employees contribution, it is taxable. The amount is taxable for all types of provident funds, whether it is a government provident fund, the recognized provident fund, or unrecognized provident fund. Employees contribution is taxable. That is, we would have to pay tax on employees contribution. But remember, let's just say someone's basic salary is, let's just say 80,000 rupees, 80,000 rupees per month, right? And we have 12 months, so that would be 9,60,000 rupees per year. But his employees contribution, let's just say employees contribution is 10,000 rupees per month, and we are saying that this 10,000 rupees is taxable. That means we would have to pay tax on this 10,000 rupees. So should we do it like this? Employees contribution is 10,000 into 12, that is 1,20,000. Now should we pay tax on the sum of these two, that is 9,60,000 and 1,20,000? That would be 1,80,000. Should we pay tax on this 1,80,000? This is a wrong approach. Why is that so? Because this 10,000 is being paid out of this 80,000, right? So we do not get this whole 80,000 amount as take-home salary, but rather 10,000 is already deducted and is being submitted in some bank deposit amount. So we do not need to recalculate, because this 10,000 is already included in this 80,000, right? So for example, an employee, if his basic salary is 10,000 per month, basic salary, then he would not get this whole 80,000. Rather, when he would get the amount, then the employee contribution would be deducted, right? So rather 80,000, he would get 70,000 rupees. So 80,000, this 10,000 is already included in this 80,000. We do not need to again recalculate. It is taxable. It means that we would have to calculate tax on this whole 80,000 amount rather than this 70,000 amount. Then there is employer contribution. So in case of governmental funds, employer contribution is not taxable, right? So we do not need to pay tax on employer contribution. In case of recognized provident fund, there is a formula that we need to use. It would not be taxable if it is lesser of 10% or 1,50,000, right? So lesser of 10% of, so we need to calculate 10% of basic salary plus dearness allowance. Let's say that 10% of basic salary and dearness allowance is 1,20,000 rupees, and then we have this 1,50,000 rupees. So lesser of this amount is not taxable, right? So in this case, this recognized provident fund, the employer's contribution is not taxable. But let's just say, let's ignore this scenario. Let's just say the 10% of basic salary and dearest allowance is 2 lakh rupees. And then we have this 1 lakh constant amount which is coming from here. So it says lesser of these two. Which one is lesser? It is 1,50,000. This one amount is excluded. We would not pay tax on this amount. But in case it exceeds, the excess amount will be included in tax. So what is the excess amount? This would not be taxable. The difference between these two is 50,000 rupees. So this 50,000 rupees would be taxable. So you got the idea, right? 10% of basic and dearest allowance or 1,50,000, whichever of these amount is lesser, that is exempted. We do not need to pay tax on that amount. Other than that, we would have to pay tax. In case of unrecognized fund, it is not taxable. Employer's contribution is not taxable. Now you would be getting confused over here that in case of governmental fund, we understand that it is not taxable because the government is providing the contribution. In case of recognized, although it is recognized, but it is not governmental fund, so there is some kind of taxation being applied overhead. But unrecognized fund are the funds that are not recognized by federal board or the commission. Then why they are not being taxed? They should be taxed rather a higher amount, right? This is what our common understanding is. But hold on to this concept and we would discuss it in a couple of slides. Next comes the interest treatment. Again, in case of governmental fund, interest is not taxable. In case of recognized provident fund, if the interest amount, the interest percentage is less than 16%, then it is not taxable. And if the interest amount is less than 1/3 of the salary, right? So if salary is, let's just say 60,000, then 1/3 of this salary would be 20,000. So if this interest amount is, so this interest is less than 20,000, which is 1/3 of the salary, and if the interest percentage, interest rate is less than 16%, then in this case it is not taxable. What if the interest rate is 17%, right? In that case, the excess amount will be taxable. That means only 1% amount would be taxable and the rest would be exempted. Okay. Again, in case of unrecognized fund, the interest payment or the interest amount is not taxable. Again, you would be confused over here that it is an unrecognized fund. It should be at the disadvantageous end. Rather, it is at the advantageous end. Then what is the advantage of getting your fund recognized? If unrecognized funds are not taxable, then why should we get our fund recognized? But hold on for a minute. Now comes the lump sum amount, the amount that is paid at the time of retirement, the accumulated balance. In case of governmental fund, the accumulated balance is not taxable. In case of recognized fund, the accumulated balance is not taxable. The amount when you get retired, the lump sum amount of that you would received would not be taxable. But in case of unrecognized provident fund, the employer's contribution and the accumulated interest rate would be taxable. Employer's contribution had already been taxed, right? But the employer contribution and the accumulated interest will be taxable. Now you get the idea that the unrecognized provident fund are at the disadvantages, because when the employer would retire, he would have to pay a higher interest on the lump sum amount, and when you have a higher amount, you are in a higher tax slab. We would discuss this tax slab later on our lectures. And when the tax slab increases, the percentage of tax also increases. So unrecognized funds are at disadvantages and in this way. Let's have an example. Mr. A's annual salary is 6,50,000. He contributes to recognized provident fund. Now you get the idea. It is not governmental or unrecognized provident fund. It is a recognized provident fund. During the tax year of 2019, the working of provident funds are as follow. Employees contribution is 65,000. Remember, it is automatically included in salary. So we do not need to again include it. The 65,000 is already included in this annual salary. It is taxable, we know that, but it is already included there. The employer contribution is 65,000. You would have to see what is the rule regarding employer's contribution, and then the interest rate is at 15% and the total amount is 54,000. So let's solve this question. Okay, so first we would start with the basic salary. The basic salary is 6,50,000. Then the employee's contribution it is automatically included, so we will not include it again. Then we have employer contribution. Okay, so what is employer contribution? It is 65,000, right? And what is the rule regarding employer contribution in case of recognized fund? Let's go towards this slide. In case of recognized fund, 10%, lesser of 10%, or 1,50,000, it would not be included, right? It would not be taxable. So 10% of employer of salary is 6,50,000. So 10% of this is 65,000 or 1,50,000. Whichever of this one is lesser, this one is lesser. This is exempted. What do we mean by exempted? Tax would not be calculated on this one. So in this case, again there would be, we would not include any employer's contribution because 65,000 is exempted. Now comes the case of interest, and interest is 15%. So regarding interest, what was the rule? Okay, the rule was if it is less than 16%, so in our case it is 15%, so this rule is satisfied. And if the interest amount is less than 1/3 of a salary, so interest amount in this case, the interest amount is 58,000, and 1/3 of this 6,50,000 is going to be obviously greater than okay, so this 6,50,000 divided by 3 would be 2,166,66, so 2,16,000 almost. So this 58,000 is less than 1/3 of the salary. So again, this would also be not included in the taxable income. It is exempted. Interest 0, so the total taxable income would be 6,50,000. So that's all for this lecture.